What happened in the last 72 hours represents the most significant fracture in the global oil order since the 1973 embargo, and every government that depends on affordable energy is currently scrambling to understand what it means for their economic survival. The phone call that came from Riyadh to Washington 3 days ago contained a message that American officials had convinced themselves they would never hear. Saudi Arabia will not increase oil production to offset Iranian supply disruptions, regardless of the consequence for global markets or the American economy. This is not a temporary diplomatic disagreement. This is not a negotiating tactic. What we are witnessing is the structural breakdown of the 50-year arrangement that has governed global energy markets since Henry Kissinger and King Faisal created the petrodollar system in 1974. The Saudis have made a calculation that their long-term survival depends on breaking with American demands. And that calculation tells us everything we need to understand about the terminal phase of American imperial power in the Middle East. I am going to take you inside every dimension of this moment. How did OPEC reach this breaking point where the organization's most important member openly defies American pressure? What does this split mean for energy prices, inflation, and the stability of economies that have built themselves on assumptions of affordable oil? And what does Saudi Arabia's refusal tell us about the fundamental realignment of power that is accelerating across the Middle East and the broader global system? There are 3 questions that will structure everything that follows. First, what specifically happened in the emergency OPEC meeting that took place in Vienna 48 hours ago? And why did it produce an outcome that contradicts every expectation built into Western economic planning? Second, what is the game theory that explains why Saudi Arabia chose this exact moment to break with American demands despite decades of strategic alignment? And third, what are the cascade effects that will follow from this decision across energy markets, inflation dynamics, geopolitical realignments, and the structural stability of the petrodollar system itself? By the end of this analysis, you will understand why this moment represents an inflection point that historians will study as the beginning of a fundamental reorganization of global power. Let me walk you through exactly what happened and why it matters more than almost anything else occurring in the world right now. Arbitrary, the Vienna meeting and what actually transpired, the emergency OPEC meeting convened in Vienna on Tuesday morning with a single item on the agenda: whether the organization would increase production to offset the removal of Iranian oil from global markets. The American position, communicated through both diplomatic channels and public statements from the Treasury Department, was unambiguous. The United States expected OPEC, and specifically Saudi Arabia, to increase production by approximately 2 million barrels per day to prevent oil prices from spiking above $120 per barrel. This expectation was not unreasonable based on historical precedent. Every time Iranian oil has been threatened or removed from markets over the past 4 decades, Saudi Arabia has increased production to stabilize prices. In 2012, when sanctions reduced Iranian exports by 1 million barrels per day, the Saudis added production. In 2018, when the Trump administration withdrew from the nuclear deal and reimposed sanctions, the Saudis again increased output. The pattern was so consistent that it had become embedded in economic models and policy assumptions across Western governments and financial institutions. The meeting lasted 6 hours. When it concluded, the official statement was remarkable for what it did not say. OPEC announced that current production quotas would remain unchanged. There would be no emergency increase. There would be no coordination with the International Energy Agency to release strategic reserves. There would be no acknowledgement of American requests or Western economic concerns. The Saudi energy minister, speaking to reporters after the meeting, delivered a statement that deserves to be quoted in full because every word was calculated for maximum impact. Saudi Arabia's production policy is determined by our assessment of long-term market stability and the interests of producing nations. We do not respond to short-term political pressure from any external party. Current production levels reflect optimal market balance. That phrase, any external party, what to store into was diplomatic language for a message directed specifically at Washington. The era of automatic Saudi compliance with American demands is over. Let me give you the numbers that explain why this matters. Iranian oil exports have declined by approximately 1.8 million barrels per day over the past 6 months due to intensified sanctions enforcement and the effective closure of several key export routes. Global oil markets had anticipated that Saudi Arabia would offset at least 1.5 million barrels of this reduction. When the Vienna meeting concluded without that commitment, crude oil futures spiked by $38 per barrel in overnight trading, moving from $82 to $120 within 14 hours. This price movement translated immediately into refined product markets. Gasoline prices in the United States increased by an average of 95 cents per gallon overnight. Diesel prices, which are more directly tied to crude costs due to lower inventory buffers, increased by $1.30 per gallon. Natural gas prices in Europe, already elevated due to reduced Russian supply, increased by 42% as utilities and industrial consumers scrambled to secure alternative energy sources. These are not temporary fluctuations. These are structural price adjustments that reflect the new reality of constrained supply without the Saudi safety valve that has prevented previous price spikes from becoming sustained price regimes. Barsir, the game theory of Saudi defiance. Now, we need to understand why Saudi Arabia made this choice, because understanding the incentive structure reveals everything about the broader geopolitical transformation occurring across the Middle East and the global system. In game theory, every player is trying to maximize their own interests based on their assessment of costs, benefits, and the likely behavior of other players. The question we must ask is simple. What does Saudi Arabia actually want, and how does refusing American demands serve those interests better than compliance? The conventional understanding of Saudi interests, the one that has governed American policy for 50 years, assumes that the kingdom's primary goal is maintaining security guarantees from the United States in exchange for oil market management and petrodollar system support. Under this framework, Saudi Arabia should always comply with American requests because the security guarantee is more valuable than short-term economic gains from higher oil prices. But this framework is based on assumptions that are no longer valid, and Saudi decision makers have clearly concluded that the old arrangement no longer serves their interests. Let me explain the structural changes that have transformed Saudi calculations. First, American security guarantees have been systematically devalued through repeated demonstrations of unreliability. The United States did not prevent Iranian-backed attacks on Saudi oil facilities in 2019, despite those attacks removing 5% of global oil supply. The United States withdrew from Afghanistan in a manner that demonstrated either unwillingness or inability to maintain commitments to regional partners. Most significantly, the United States has proven incapable of containing Iranian influence across Iraq, Syria, Lebanon, and Yemen, despite 2 decades of effort and trillions in military spending. From the Saudi perspective, what exactly is the American security guarantee worth if it did not prevent attacks on Abqaiq and Khurais, did not contain Iranian regional expansion, and appears increasingly uncertain given American domestic political dysfunction and fiscal constraints? Second, the Saudis have conducted their own game theory analysis about the future trajectory of American power and reached conclusions that American officials find uncomfortable. If the United States is entering a period of sustained relative decline, then aligning Saudi interests with American demands becomes progressively more costly and less beneficial. The optimal strategy in that scenario is to begin hedging relationships with rising powers, particularly China, while reducing dependence on American security architecture. The evidence suggests this strategic hedging is already well advanced. Saudi Arabia has signed comprehensive strategic partnership agreements with China covering everything from energy to technology to currency arrangements. The kingdom has indicated willingness to accept payment for oil exports in yuan rather than dollars. Saudi officials have conducted military exercises with Russian forces. The kingdom has restored diplomatic relations with Iran through Chinese mediation, a development that would have been impossible under the old American-centric regional order. Third, and this is the critical calculation, the Saudis have determined that higher oil prices serve their interests better than maintaining the American relationship at its historical intensity. Let me walk you through the mathematics that support this conclusion. Saudi Arabia produces approximately 9 million barrels of oil per day. At $80 per barrel, annual oil revenue is approximately $260 billion. At $120 per barrel, annual oil revenue is approximately $390 billion. That is an additional $130 billion per year, every year that prices remain elevated. This additional revenue solves multiple structural problems for the Saudi state. It funds Vision 2030 economic diversification programs without requiring additional borrowing. It allows increased military spending to build independent defense capabilities that reduce reliance on American protection. It provides fiscal resources to manage the domestic political challenges of youth unemployment and subsidy reduction. Now consider the alternative scenario. If Saudi Arabia increases production to stabilize prices at $80 per barrel, as the United States demands, the kingdom forgoes $130 billion in annual revenue while simultaneously strengthening the American economic position and postponing the fiscal crisis that might force American retrenchment from the Middle East. Why would Saudi Arabia choose the option that leaves it poorer while strengthening a security partner whose guarantees have proven unreliable and whose long-term trajectory suggests inevitable withdrawal from the region? The game theory is clear. Saudi Arabia maximizes its interest through higher oil prices and accelerated diversification of security partnerships. Compliance with American demands serves American interests, not Saudi interests. Once that calculation becomes clear to decision makers in Riyadh, the old arrangement becomes unsustainable regardless of historical precedent or diplomatic pressure. Arsader, historical pattern, recognition, and imperial overreach. This moment fits into historical patterns that recur across civilizational timescales, and understanding those patterns allows us to predict where this trajectory leads with uncomfortable clarity. Throughout history, empires that have extended themselves across multiple theaters while facing fiscal constraints and declining relative power have experienced the same cascade of defections by peripheral allies who conclude that the imperial center can no longer provide sufficient benefits to justify alignment costs. Rome experienced this pattern in the 3rd century as provincial governors recognized that Rome could no longer defend frontier territories and began establishing independent relationships with neighboring powers. The generals who had once enforced Roman order became the warlords who carved the empire into competing domains. The British Empire experienced this pattern after World War I as the fiscal cost of maintaining global commitments exceeded Britain's economic capacity to sustain them. Dominions and colonies that had previously accepted British authority began demanding independence or negotiating alternative arrangements. The process accelerated after World War II when Britain's relative economic decline made the cost of empire obviously unsustainable. The Soviet Union experienced this pattern in the 1980s as Eastern European states and Soviet republics recognized that Moscow could no longer provide economic benefits or security guarantees sufficient to justify continued alignment. Once this recognition became widespread, the defection cascade occurred with remarkable speed. The empire that had appeared stable in 1985 had effectively dissolved by 1991. The pattern is consistent across different empires, different time periods, and different specific circumstances. When peripheral allies conclude that the imperial center can no longer deliver sufficient value, they begin hedging relationships with alternative powers. This hedging accelerates into open defection once enough actors have shifted that remaining aligned carries opportunity costs and potential risks from the emerging order. The American position in the Middle East is exhibiting every characteristic of this historical pattern. Saudi Arabia's refusal to increase oil production is not an isolated event. It is one data point in a broader pattern of regional actors hedging and increasingly abandoning alignment with American preferences. Turkey, a NATO member, has purchased Russian air defense systems despite American objections and threatened sanctions. The United Arab Emirates has expanded economic and security cooperation with China while reducing coordination with American regional strategy. Egypt has purchased Russian weapons and joined BRICS despite receiving billions in American military aid. Qatar maintains relationships with Iran and Hamas despite hosting the largest American military base in the region. Each of these examples represents rational calculation by regional actors who have determined that exclusive alignment with American interests no longer serves their own interests as effectively as diversified relationships with multiple powers. The Saudi decision on oil production is simply the highest profile and most economically consequential example of this broader pattern. It matters more than the other examples because oil markets are the mechanism through which Middle Eastern decisions directly impact Western economic stability. When Turkey buys Russian missiles, it is a geopolitical irritant. When Saudi Arabia refuses to increase oil production, it is an economic crisis that affects inflation, interest rates, employment, and political stability across the developed world. Our economic cascade effects and system-level implications. Now we need to examine what happens next because the immediate price spike is only the beginning of a cascade that will ripple through interconnected economic and political systems in ways that amplify far beyond the initial trigger. Let me walk you through the cascade mechanism step by step so you understand why this is not simply a temporary energy price shock that will be resolved through market adjustments. Step one is the immediate impact on consumer economies. Gasoline and diesel prices have increased by approximately $1 per gallon overnight. For the average American household that consumes approximately 60 gallons of gasoline per month, this represents an additional $60 in monthly fuel costs. Multiply that across 130 million households, and you have nearly $8 billion per month in reduced consumer spending capacity. But fuel costs are only the direct effect. Transportation costs feed into every product that moves through supply chains. Shipping companies immediately implement fuel surcharges that get passed to retailers who pass them to consumers. Food prices increase because agricultural products require both diesel for farm equipment and diesel for transportation to processing facilities and retail locations. The Department of Agriculture estimates that a sustained 40% increase in diesel prices produces an 8 to 12% increase in food prices within 4 to 6 months. Step two is the inflation acceleration and monetary policy response. The Federal Reserve has spent 18 months attempting to reduce inflation through interest rate increases. Those efforts had begun to show results, with inflation declining from 9% to approximately 4%. A sustained energy price shock of the magnitude we are now experiencing will reverse that progress immediately. Core inflation will spike back to 7 or 8% within 60 days as energy costs feed through to broader price indices. The Federal Reserve will face an impossible choice: continue raising interest rates to fight inflation despite knowing this will trigger recession, or pause rate increases and accept that inflation will become entrenched at levels that erode living standards and political stability. Either choice produces economic pain. Higher rates mean increased mortgage costs, reduced business investment, higher unemployment. Sustained inflation means real wage decline, reduced purchasing power, erosion of savings. The political consequences of either scenario are severe, but the combination of both, which is the likely outcome, creates conditions that challenge political stability itself. Step three is the fiscal cascade at the federal level. Higher interest rates mean increased cost of servicing the $33 trillion national debt. Every 1 percentage point increase in average interest rates costs approximately $330 billion in additional annual debt service. The Congressional Budget Office projects that debt service costs are already approaching $1 trillion annually. The combination of higher rates and increased borrowing to offset recession will push debt service toward $1.5 trillion, consuming resources that might otherwise fund defense, social programs, or infrastructure. Step 4 is the geopolitical leverage transfer. Every dollar increase in oil prices transfers wealth from consuming nations to producing nations at a rate of approximately $100 billion per year. At current prices, this represents a $4 trillion annual wealth transfer from the West and Asia to OPEC members and other oil exporters. This is not neutral redistribution. This is strategic empowerment of actors who are increasingly aligned against American interests. Russia earns an additional $70 billion per year at $120 oil, funding military operations in Ukraine and strategic competition globally. Iran earns an additional $40 billion despite sanctions, funding proxy networks across the Middle East. Saudi Arabia earns an additional $130 billion that it can invest in alternatives to American security architecture. The wealth transfer is simultaneously weakening consuming nations through inflation and economic strain while strengthening producing nations that are actively working to build alternative systems to American-led international order. Step 5 is the petrodollar system stress. The mechanism through which oil transactions denominated in dollars create sustained demand for American currency depends on producing nations recycling oil revenues into dollar-denominated assets. If Saudi Arabia and other producers begin diversifying those investments into yuan, euros, or gold, the structural support for dollar dominance weakens progressively.